Hello and welcome back to Mergerverse. So today we'll cover the part 2 of how PE funds work. Now in the previous video in part 1 we covered the structure of PE funds and how they invest into target companies. Today we are going to focus on the tax and substance requirements that the PE funds and how they fulfill specifically for India focused or India investing PE funds. Now a lot of the things that we will cover in this video we have also discussed in some other videos. I'll point out to those videos specifically in those parts. So let's start. So a structure of PE fund that we covered previous video, which is investing into India, is they'll set up a master fund in Cayman or US, and then there will be a sub fund which will be in Singapore or Mauritius, and below that sub fund will be the investing entity. This entity will hold shares of the Indian company, and then this will acquire the target company in India. Now most of these funds are collected by the master fund from various high net worth individual pension funds, endowment funds in various countries, and they invest those money into sub funds, and then that sub fund specifically allocates the amount that is to be invested into the target company in the investing entity. And generally this investing entity will only hold one asset, that will be the shares of this company, or if it's more assets, all of its assets will be related to the shares of this company or the business of this company. So moving forward, now there is a specific investment management structure that the PE funds follow. So the fund entity here, this investing entity and this sub fund, will not do any other business other than holding these specific assets. However, as you will know, PE funds will have a lot of employees who will evaluate various investing opportunities, look after their portfolios companies and other things. So most of those employees are in an investment management entity. This is where all the employees of PE funds sit. So what this structure does is, investment management entity provides services to all of these entities, the master fund, the sub fund, the investing entity, and sometimes even to the targets if required. Like sometimes the target may require some professional services. However, generally those are very rare. Most of these services will be to these two funds. What kind of services? So they will provide their expertise in relation to identifying the target before investing into the Indian company, undertaking the due diligence for this Indian company and other things relating to that investment, and then thereafter maintaining that investment. And for these services, all these entities will pay to this investment management entity a management service fees or a management agreement fees, and that fees is one of the most important line items in the financial of these entities, because specifically this is the main expense that these entities will occur, and this expenditure is very relevant. If you had seen our video on the LOB clause of India Singapore Treaty, that is clause 24A, that we cover that clause requires to claim benefit under article 13 4A or 4C. You need to have a certain expenditure to be incurred by the Singapore entity or the Indian entity taking benefit of the India Singapore DTAA. So this is one of the most important expenses, because this is generally the only expense that they would incur. Now, as we have covered in other videos also, substance is one of the most important requirement to take the treaty benefits, and this has become even more important in wake of the recent ruling in the Tiger Global judgment. So I'll link the video to the Tiger Global judgment in the I button above. So basically, for the India Singapore or India Mauritius TTAA, there was relief on the sale of shares which were acquired before 1 April 2017. Further, there is another aspect that we discussed was the indirect transfer under Article 13.5. Now that is related to the Tiger Global ruling, so you should look those videos up. But for both of those clauses, not specifically for 13.5 but for especially for 13.4 and in other aspects also, even if you are not taking the capital gains benefit for any other treaty rate, for example royalty or for interest income, there are other treaty benefits also. You would require to establish that the entity has a substance in Singapore or Mauritius, whichever is applicable, and those substance tests are going to get more and more stringent as with these rulings the tax authorities start to go deeper into these fund structures. And also in recent years, if you specifically look into Singapore, so Singapore has brought in their own substance requirements which are known as ESR rules, and those are very broad in they require various things for a company to comply with to be able to establish their substance in Singapore. Some of those aspects in building real substance in those entities are having operational business in those entities. Then there is director. So for operational expenses, we have discussed this specifically requirement of the clause 24A of also of the LOB clause of article of the DTAA. And as we discussed earlier, the MSA cost or the MSA fees that they pay to the investment management entity is one of the most important part to comply with this cost. Then other aspects are the board composition. Now most countries require the board of directors to be majority residents of that country. So for example, if the investing entity is in Singapore, so the board of this investing entity should have majority of directors resident of Singapore. Now if you would understand this, this investing entity has no major business, and so there will be unlikely to be any major employees in this. Most of the employees of a P fund are in this investment management entity that has employees across the globe. A lot of them may sit in US, some may sit in India, some in other countries. Now what happens is this P fund may nominate some of the people to act as directors for this investing entity. Now that person who this investment management entity may nominate may not be the resident of Singapore or Mauritius, and may be sitting in US or other country. And so what they will try is that the one director is sitting in US, and then there will be a couple of directors in who are resident of Singapore. And so for that, a lot of P funds enter into a agreement with local compliance firms that provide them accounting and Companies Act compliance services, and along with those services, those entities also provide them couple of directors to make this majority resident. However, those directors are not given power to take major decisions. So if that is challenged, there could be a issue with explaining to the tax authorities that you have real substance in Singapore. So it is preferable for P fund to have majority of directors who have the ability to take decisions, who are resident of the country in which that investing entity is incorporated. Specifically, this aspect was analyzed in the Tiger Global ruling, in which the structure was similar. There were two resident directors based in Mauritius and then one non-resident directors, but he had more decision-making capabilities. So this is something that is going to get interesting in going forward based on the recent developments, and also in the laws that have been passed in Singapore, and maybe in the future Mauritius might make more stringent laws. The other requirements obviously is the certificate of residence or TRC rules of those specific countries, and as we've discussed, Singapore has increased the threshold requirement for the certificate of residence. That requires now board composition, board minutes, physical board meetings to be held in Singapore, then the financial statements to be prepared in Singapore, bank accounts being maintained by a person based in Singapore. These rules are very similar to the POEM guidelines in India. However, in Singapore there is no clear framework laid down. These are more guidance that has been provided by their tax authorities. Now Mauritius is not as stringent as Singapore, but in the future it may increase to match with the global requirements. And as again we have discussed with the Tiger Global ruling, TRC may no longer be sufficient for treaty benefits. So these are some of the aspects that they need to evaluate for a P fund to establish their substance. And this is important because most of these entities would not want to incur any additional expenses beyond that is necessarily required as it will affect their IRR. So if to comply with these rules, if they have to increase their, let's say they have to employ a person within that entity, or they have to do additional compliances, that could also affect their IRR. So these are some aspects that have to be evaluated by this fund industry going forward. Now your homework for today is find out 2 Indian listed companies which are owned by PE funds, and for each company identify where is the holding company located, and think about why that jurisdiction is chosen, and you can write it down which is that company, where which PE funds hold is, where is it located, and any other information that you find in those financials that you think is interesting. And in part 3 we will cover the management incentive structures of PE funds, and then thereafter we will focus a little bit more on other aspects of repatriation for PE funds and why they may require it. So thanks for watching.